Hello, my dear friends. This is Chinmaya Hegde, your learning partner in CA Final SFM and Financials Reporting. So, I'm here now to talk about the great news, the fall of oil price. I'm sure most of you would have heard of it by now. If not, I'm telling you now. This is the first time ever in the history that oil price has reached negative number. You heard me right, negative number. So in this segment, we are going to talk about what you mean by this negative number, what is the interpretation of this, why it happened, and we will connect this with certain theoretical topics relevant for your examination, CA final. I'll try to talk about the commodity futures and little bit of economics, and also about maybe your accounting standard, one of the element in the accounting standards. Also, I'm going to apply it. So if you're a foundation student, economics is there for you. If you're an intermediate student, you have accounting standard application. If you're a final student, you have everything, of course. Commodity futures is for us to understand. Okay, let us begin now. This is one of the screenshot. I took it from one of the websites. Various websites are there. You also can search it out in the Google. Crude oil, you can see minus 7.13. You can see here minus 7.13. Market watch is the website. Oil price charts. WTI crude last is minus 6.7, minus 6.3, and other crudes are also there. This is minus 6.3. And this is the data which I have taken it from the website cmegroup.com, where I can compare the different future price. Okay, now first let me talk about what is this negative price. Negative price, or let's say minus 6.25, minus 6.3, all these things. Does it mean that when you purchase something, you also get the price? Yes, that is the normal meaning, definitely, for sure. Normal transaction, you purchase something and you make a payment for it. But this negative number means the buyer will get the goods and the buyer will get the money. Double benefit. The goods as well as the money you are getting. So in this 6.25 means the buyer of the the buyer of the product will get the oil, as well as he will get the rupee, or not the rupee, this dollar 6.25, the person who is purchasing it. So seller will give the dollars also, seller will give the product also. Okay, one thing to make it clear, it is not the negative number in spot market, it is the negative number in future market. Your CA students, I hope you're able to understand. Spot market, this is still a positive number, but in the negative market, it has, in the future market, it has become negative. Now, let's talk about the commodity futures. This is what you can see. I'll come back to this. Commodity futures. What is commodity future, my dear friends? You know the formula, you would have learned. If not, you learn it now. Future price is equal to spot price plus interest. That you know, the time value of money plus the cost of storage minus the convenience yield. Convenience yield. This basically is the income that you're expecting from the market, from that product. Storage cost is one of the important element in commodities. That's why when we talk about index future or about share future, we don't consider the storage cost much. We don't give much of importance. It's very minimal, so we don't consider it. But the commodity storage cost is very heavy. It is one of the integral part. That is why in the formula you can see we are having the storage cost as the formula. Now what is happening? Observe this, or what happened in the oil. There is a expiry date coming. There is an expiry date coming. On the expiry date, the future market can be settled either by delivery basis or by cash basis, that is net basis. So it can be settled by delivery basis or it can be settled by cash basis. But if you want to settle by net basis, cash basis, the buyer has to intimate the seller before a certain date. If it does not intimate, it will automatically become settlement by delivery basis. That's what happened now. Before the expiry date came, the intimation date was there and many people did not intimate, or therefore many people forced to take a delivery of it. That is the future play, my dear friends. If you remember, I keep telling this. Future is a very risky. Anybody can come and sign the contract in the spot market. You make a payment and get the product, but in future segment you just sign a contract, keep a margin with the broker or with the person with whom you deal, but it is signing a contract, no cash flow involved. Anybody, whether they have money or not, they are going to enter into a contract and speculating it big time. Now what happened? They are forced to take a delivery, and if you take a delivery you have to maintain it. It is not your mobile phone to keep it into your pockets. It is barrels of oil. It is to be kept in a certain conditions. It has to be kept in a certain conditions. It requires a cost. It requires storage. It requires a maintenance cost. It is a perishable commodity. If you don't maintain, it will evaporate automatically. So to keeping it with you, you need money for it. To keep it with you, you need money for it. For example, let's say the price of the product is 20 rupees. Okay, that is the price of the product. And if the storage cost is 30 rupees, why will you buy the product? You buy the product and 30 rupees and you incur 30 rupees. You buy the product 20 rupees and you incur 30 rupees. It's not going to make sense. So what they're telling, okay, I will not pay 20 rupees and I will not spend 30 rupees. I will sell it to you. I'll pay you 8 rupees. Take it. Take the product and take the money also. Because if I purchase the product, 20 rupees and storage cost also have to spend, and I am not able to sell, means it becomes useless. My total loss will be high. Rather than that, 10 rupees, 8 rupees, 12 rupees, oh not rupees, dollars, I will pay it to you. Hope you're able to understand. Now the question comes, or other way around, you're not in a position to incur storage cost and your spot price also becoming zero and your loss is exceeding your any amount that you can recover. Let me just bring the context to you once more. What really happened? It is related to a buyer in the future contract who just signed the contract, but now at the time of expiry he is not in a position to take the delivery, because even if he takes the delivery he has to store it somewhere where the cost he cannot incur. So instead of incurring that cost on storage and without any benefit, he is telling, I will pay you the money. You don't give me the dollars, you don't give me the barrels, you don't give me the oil, you keep it with you. I am not able to maintain this. I cannot maintain this. My storage cost is high. It is not possible. So the biggest word what you're going to learn here is storage. Why? Storage is so much important in commodity futures. So my dear friends, hope you understand commodity future, why storage cost is so much important. I'm sure everybody is suffering corona effect, but every difficulty gives us learning opportunity. This is the first time this has happened, and this is the best time for you to learn commodity future practically. Okay, now let us go back to that. Please observe, there are various future contract, May future contract, June future contract, July future contract, and spot contract, spot transaction. Please observe, it's only the May future contract which is going to be delivered, which is going to be expired soon, that is negatively correlated. June month, July month is not negative price. June month, July is not in negative, they are in positive. So don't be too much stressed out that your oil is coming negative, or don't be too happy. Okay, I will go to petrol bunk, I'll get petrol also, I'll get money also. So don't go to either of the extremes. So point to be kept in mind is futures, commodity futures are influenced by the storage cost, and when you're not able to incur the storage cost, the price can go negative. That's the only point you have to keep it in mind. Don't have too much of any extreme observation. Now let's come to the convenience yield part. I told you convenience yield is the expected profit or loss in this case. Now I told you storage has a problem. Now why you're not able to store, or why the price is coming down? Let's see little bit about economics. You know, in economics, demand curve and supply curve, the intersection point is the price at which it is going to be delivered. Now what happened, or what is happening, the oil supply companies, production companies continued, because of various political tensions or their egos, I don't know, but production continued, or at least they have not stopped the production. But what happened to demand due to this coronavirus? One of the major usage of oil is airline industry. They are not operating, almost shut down. Most of the economies are down. US economy, UK economy, Indian economy, the consumer economies are down. So petrols are not finding, petrol mean oils are not finding any demand, but supply continued to happen. Supply, that is production happened, and it has to be kept in a storage. It's a perishable commodity, it is a chemical, I mean, it has to be kept in a certain place, otherwise dangerous also. So supply happened, it is storage in a certain place, and the storage capacity is now over. Supplies, there is a problem, and demand, what is happening? Please observe, when the demand comes down, I mean the supply remains same, but when the demand comes down, you see that this point going up, you see demand is here, but if demand comes down here, what will happen to the price? Coming left side means demand is coming down. You see price increase, again demand less, price increase, demand less, price increase, demand less, the price will increase. So the real problem is because of this corona effect, demand for the oil is having a big hit. And first of all, oil was down for the last few months. Oil issue was always there, and corona effect now is adding fuel to the fire, maybe completely burning the oil. Certain countries like India have got some extra uh, space to storage the oil. I don't know how much, but there are news that there are available, so India may get a advantage of this situation. Anyway, keeping that aside, so 2 point we understood, commodity future storage is the main element. And why storage is becoming constrained? Because the demand is reduced, and substantially reduced, but the manufacturing or the supply did not reduced. So storage capacity is not there, and now nobody is ready to take the delivery if they want to dispose it off. Okay, being a FR faculty, I should also talk about accounts. Let me talk about the accounts portion after this. This is Ind AS or AS 29 or Ind AS 37. Onerous contract or onerous contracts are there. What are onerous contract? Where there is a contract in place where the benefits is more or cost is less, or cost is more or benefits is less. When the unavoidable costs are exceeding the benefits, you are going to incur a loss. Let me give you an example. Suppose there is the contract to supply certain products, okay, at rupees 30 per kg. And if you don't supply within a certain date, let's say you are on 31st of March 19, let's say we are in 20 now, and you have to supply within 15th of April 2020 certain number. If you don't supply, you have to pay penalty of, let's say, 5 rupees for every kg. Now, as on the 31st of March, if you manufacture this or if you purchase this, your cost is 32 and your benefit is 30. So, you are going to incur a loss of 2 rupees. But if you don't purchase, what will happen? You are going to cancel, means you have to pay penalty of 5 rupees. So, 5 rupees. So, either you have to pay 2 rupees, incur 2 rupee loss, or you have to incur 5 rupee loss as a penalty cost. Which is better? Is it better to incur 2 rupee loss or 5 rupee loss? One of them is sure. That is what is onerous contract. Onerous contract means there is a commitment where the future benefits is lesser than the cost, which are unavoidable. We take whichever is lesser loss and we account it in the accounts as onerous contract. We make a provision for expense and we create a liability. That is what is happened exactly now, where people are having a situation that if you purchase the oil and then sell, you are going to incur a huge loss. Rather than that, you are ready to pay cost out of your pocket. You feel that that is much better. Okay, so this is the 3 points we understood: the commodity futures, storage impact, why demand reduced, linking with economics, and onerous contract, linking with accounting standards. Hope you have enjoyed. If you have any questions, please do leave a comment here, and hope you learned something by spending last 15-20 minutes. So it's a problematic situation for everybody, but there is no problem situation for learning new things. So stay home, stay safe, happy learning. Thank you.